What I'm about to show you could save your entire investment. Right now, silver is trading around $90 per ounce. Millions of Americans own SLV, the iShares Silver Trust, thinking they own silver. But here is what they are not telling you. Authorized participants may not be able to readily acquire sufficient amounts of silver. The trust may suspend or restrict the issuance of new shares. That is directly from the SLV prospectus. BlackRock, the company that manages SLV, is warning you that they might not be able to get silver, that your shares could be suspended. But it gets worse, much worse. The paper-to-silver ratio has skyrocketed to 408.1, according to the U.S. debt clock. This means each ounce of physical silver now theoretically backs 408 ounces of paper silver derivatives. 408 paper claims for every 1 real ounce. If even a small fraction of those claims demanded delivery, the entire system collapses. If you own SLV, you need to watch this entire video. If you think SLV is the same as owning silver, I am about to show you why it is not, and why your paper silver could go to zero overnight. Welcome to AG Profit Hub. This is where we cut through the noise and expose what is really happening in precious metals markets, while everyone else feeds you the official narrative. Subscribe right now and hit that notification bell because this is information that could save your investment. If you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see the truth. And trust me, what I am about to reveal is something Wall Street does not want you to know. Let me explain what SLV actually is, because most people do not understand this, and that misunderstanding could cost them everything. When you buy shares of SLV, you're not actually purchasing silver. You're owning a paper claim on the metal held by the trust. Investors cannot take delivery of physical silver, which means your investment exists only on paper. Let me say that again so it sinks in. You cannot take delivery. You cannot convert your shares into actual silver. You own a piece of paper that says someone somewhere is holding silver on your behalf. Now, let me show you who that someone is. The SLV sponsor is iShares Delaware Trust Sponsor LLC, a subsidiary of BlackRock, Inc. The SLV trustee is Bank of New York Mellon. The SLV custodian, which oversees the trust's silver bullion stockpile, is J.P. Morgan Chase Bank, J.P. Morgan, the same bank that settled a $920 million fine for manipulating precious metals markets. J.P. Morgan has historically held substantial short positions. The bank has been implicated in allegations of price manipulation, notably settling a $920 million fine in 2020 for spoofing tactics in precious metals markets, including silver. The company that was convicted of manipulating silver prices is now the custodian of the world's largest silver ETF. Does that make sense to you? Does that sound like a system designed to protect your interests? J.P. Morgan Chase, the custodian of SLV, holds a dual role that raises questions about market integrity. As of March 2025, J.P. Morgan disclosed a 44.77% quarter-on-quarter increase in its SLV holdings, coupled with massive derivative positions, $284 million in call options, and $1.5 billion in put options. $1.5 billion in put options. That means J.P. Morgan is betting that silver will go down while simultaneously holding the silver that is supposed to back your investment. Critics argue this structure enables a scalp trade, where J.P. Morgan profits from both sides of the market. For investors, the implication is clear. SLV's price is not a true reflection of silver's fundamentals, but a product of institutional control. Now let me explain why this structure is so dangerous, because this is the part that should terrify you. ETF investors face counterparty risks that physical silver owners avoid. Your investment depends on multiple parties: the ETF sponsor's operational integrity, the custodian bank's solvency, typically J.P. Morgan for SLV, sub-custodian's reliability, and authorized participants maintaining market liquidity. Your investment depends on J.P. Morgan not failing, on Bank of New York Mellon not failing, on BlackRock not failing, on authorized participants maintaining liquidity, on sub-custodians fulfilling their obligations. If any single link in that chain breaks, your investment is at risk. Sub-custodians may hold some of the silver in other vaults. If any link in this chain fails, brokerage bankruptcy, custodian fraud, regulatory freeze, exchange closure, your access to the silver is interrupted or lost. And here is what the prospectus itself admits. If markets experience extreme disruptions, SLV holders may not be able to access their silver, leaving them vulnerable to systemic risks. SLV relies on third-party custodians, such as banks and financial institutions, to store the silver on behalf of investors. If these custodians face financial instability or legal issues, your investment could be at risk. History has shown how counterparty failures can leave investors with nothing. Counterparty failures can leave investors with nothing. That is not my opinion. That is the prospectus warning you. Now let me show you what happens when the system actually breaks. Because we have a perfect case study. In March 2022, something happened that should terrify every SLV holder. The London Metal Exchange suspended trading in its nickel market after an unprecedented price spike left brokers struggling to pay margin calls against unprofitable short positions in a massive squeeze that has embroiled the largest nickel producer as well as a major Chinese bank. Nickel, used in stainless steel and electric vehicle batteries, surged as much as 250% in 2 days to trade briefly above $100,000 a ton early Tuesday. The frenzied move, the largest ever on the LME, came as investors and industrial users who had sold the metal scrambled to buy the contracts back. And here is what happened next. The LME halted nickel trading and canceled nearly $4 billion worth of transactions earlier this month after prices spiked by 250% in under 2 days, as it sought to protect its brokers from huge margin calls owed by Tsingshan Holding Group commoners and other short position holders. They canceled $4 billion worth of trades. Investors who had made money saw their profits erased overnight. The exchange simply said, those trades did not happen. On 8 March 2022, the London Metal Exchange, LME, the world's leading base metals exchange, unpleasantly surprised us by canceling more than 7 hours of trading in nickel futures and closing the market for a week after nickel futures prices spiked dramatically. We soon came to the conclusion that without any serious improvements, we could no longer justify trading on the LME. After having traded their futures contracts for more than 30 years, we regretfully liquidated all of our LME positions. A 30-year institutional investor had to abandon the exchange entirely because they could no longer trust the market. And here is the most terrifying part. It's not a real market Armageddon until a few ETFs linked to the product are decimated. C 14th, USO, RSX, etc. WisdomTree's 3x leveraged nickel ETF is the martyr of this crisis, as Bloomberg reports. WisdomTree calculated the redemption value as 0, so all investors are wiped out. 0. The ETF went to 0. Every investor was completely wiped out. Now ask yourself, if this happened in nickel, can it happen in silver? The answer is yes. Now let me show you the warning signs that are flashing right now in the silver market. Perhaps the most underappreciated risk in the current market lies within paper silver instruments, particularly ETFs. Most silver ETFs do not operate like simple vaults holding unencumbered metal for shareholders. They rely on a complex structure involving authorized participants, custodians, sub-custodians, leasing arrangements, and unallocated metal. Under normal conditions, this system functions smoothly. Under physical stress, it does not. And we are under physical stress right now. Extreme physical stress. When physical silver becomes scarce and lease rates rise, authorized participants may be unwilling or unable to source metal for ETF creation or redemption. In such scenarios, ETFs can begin trading at persistent discounts or premiums to net asset value, suspend redemptions, or be forced into cash settlement. In an extreme squeeze, ETF shares may continue trading while the underlying metal effectively disappears from the market. The underlying metal effectively disappears. Your shares keep trading, but there is no silver behind them anymore. This is not theoretical. It is already happening in other markets. In India, strong seasonal demand coupled with a significant supply shortage is creating a deeply disrupted silver market. Prices are behaving erratically, imports have plunged, and the supply-demand situation may remain broken for a while. The situation has started to spill over into the financial markets, where investment managers have begun suspending silver purchases for their clients because of the dangerous market conditions. Keeping in mind the high spot premium for silver over the import parity price, Kotak MF is suspending lump sum subscriptions in Kotak Silver ETF Fund of Fund. Days later, UTI Asset Management in India made a nearly identical announcement, saying it also was pausing new lump sum and switch-in investments into its silver ETF Fund of Fund for essentially the same reason. Both fund houses cited domestic silver premiums trading 8 to 10% above global spot prices, reflecting severe supply-demand imbalances. Silver ETFs in India have already suspended purchases. This is the canary in the coal mine, and America could be next. During the March 2020 crisis, several precious metals ETFs temporarily suspended new share creation, highlighting these structural vulnerabilities. It has already happened once in America, and with the current market conditions, it could happen again. Now let me tell you what most paper silver holders do not understand, because this is the critical insight. If the financial system experiences a crisis, the very institutions entrusted with holding the silver or backing the derivatives could fail. This directly negates silver's traditional role as a hedge against systemic risk. Investors who purchase silver ETFs primarily for safe haven purposes might unknowingly expose themselves to the very systemic vulnerabilities they aim to avoid. You are buying silver as a hedge against the financial system, but your silver is held by the financial system. If the system fails, your hedge fails with it. Many investors are unaware that futures and other instruments can result in counterparty risk in silver markets. If the institution behind your investment collapses or defaults, your exposure could evaporate. And here is what physical silver owners understand that ETF holders do not. With physical silver, your wealth exists independently of any financial institution's solvency, broker's operations, or fund manager's decisions. This elimination of counterparty risk proved invaluable during the 2008 financial crisis, when numerous paper investments evaporated overnight. In 2008, paper investments evaporated overnight. Physical silver holders kept their wealth. Which category do you want to be in when the next crisis hits? Historical data reveals a crucial pattern. During severe market stress, physical silver premiums can spike dramatically while ETFs may face operational issues. In March 2020, physical silver premiums reached 100% above spot prices while ETFs traded at discounts to NAV. Investors holding physical silver could sell at these elevated premiums, while ETF holders faced potential redemption suspensions and couldn't access the physical metal. Physical silver holders were selling at 50 to 100% premiums. ETF holders faced potential redemption suspensions and could not access the metal. The crisis proved which form of silver ownership actually protects wealth. Now let me tell you what this means for you, because understanding the situation is useless if you do not know how to act on it. If you are holding SLV or other paper silver, understand exactly what you own. One of the primary concerns with silver ETFs like SLV is the lack of full transparency regarding their actual silver holdings. Unlike physical silver, which is a finite and tangible resource, SLV operates within a financial system where silver exposure can be artificially expanded through derivatives and rehypothecation using the same silver to back multiple financial claims. This creates uncertainty about whether SLV truly reflects silver's real market price. If you want to own silver as a hedge against financial turmoil, consider physical ownership. In short, physical silver is a real tangible asset with intrinsic value that has no counterparty risk and is difficult and costly to mine. Paper silver is not. Taking delivery or utilizing storage within a secure vault removes the counterparty risk associated with paper silver, removing it from the financial system altogether in a way that paper silver can never be. This is one of the most important advantages of physical silver, because in the event of financial upheaval, silver still belongs to the investor. Owning the physical metal is the best way to utilize silver's safe haven status and ensure investors benefit from its security and long-term store of value. The choice is yours. Convenience with counterparty risk, or true ownership with no counterparty risk. Let me leave you with this. The soaring number of paper claims relative to the available physical metal has some experts warning of a ticking time bomb in the precious metals market. This extreme divergence between paper claims and physical silver has created a fragile situation. Each physical ounce now supports an unprecedented 408 paper claims, leading many to suggest that a significant shift in demand for physical silver could trigger an explosive price surge. 408 paper claims for every ounce of physical silver, a ticking time bomb ready to explode. J.P. Morgan, a convicted price manipulator, is the custodian of your silver. The same bank holds $1.5 billion in put options betting silver goes down. ETFs in India have already suspended purchases. The LME nickel disaster proved that exchanges will cancel your trades and wipe out your investment to protect the banks. Taken together, the surge in Chinese premiums, elevated regional premiums elsewhere, rising lease rates, persistent supply deficits, and mounting ETF fragility point to a silver market under severe strain. What we're witnessing is a credibility test for paper silver markets. For savers and investors, the implications are clear. Physical ownership is non-negotiable. Counterparty risk for paper silver is higher than ever. Physical ownership is non-negotiable. Counterparty risk for paper silver is higher than ever. SLV is not silver. SLV is a paper promise dependent on banks, custodians, and financial institutions that have already proven they will protect themselves before protecting you. Your paper silver could go to zero overnight. The nickel ETF holders learned that lesson. The question is whether you will learn it before it is too late. Drop a comment telling me whether you hold SLV or physical silver. I read every single comment. Subscribe if you have not already. Hit that notification bell because this story is far from over. SLV is a trap. And now you understand why. This is AG Profit Hub because the real story is never on the surface. I will see you in the next one.